Between 2018 and 2020, the United States and China engaged in a trade dispute. Tariffs, policy changes, and official statements were widely reported, drawing attention to the evolving relationship between the two economies. While public discussions focused on decoupling and heightened tensions, financial institutions continued to direct significant capital, $1.4 trillion, into Chinese markets. These financial flows persisted with little interruption, contrasting with the prevailing public narrative. Firms, such as BlackRock and Goldman Sachs, identified ongoing opportunities in China. For these organizations, the trade dispute represented a context for reassessing global investment strategies. This approach was not a challenge to political leadership, but rather a response to global financial trends, informed by data analysis, risk assessment, and the pursuit of returns. Historically, political events often coincide with underlying economic developments. While headlines may emphasize conflict, significant changes frequently occur within financial systems and investment flows. The movement of capital is shaped by the search for growth, stability, and new opportunities. Financial decisions are often made independently of political discussions. Understanding these developments requires examining the mechanisms of global finance, including the roles of central banks, government debt, and financial indexes. These elements influence the direction and volume of international capital flows. The systems that drive the global economy operate according to financial logic, which may not always align with political objectives. The allocation of capital to China during the trade dispute reflected investors' ongoing evaluation of growth prospects. Investment decisions were based on market signals and analysis. This video will examine how these capital flows indicate changes in the global economic landscape and consider the implications for the future of finance. As investment patterns evolve, the structure of the financial world is gradually changing. The trade dispute was one aspect of a broader transformation. The more significant changes occurred within the ongoing movement of capital. To understand future trends, it is important to look beyond headlines and consider the underlying financial dynamics. Throughout history, financial superpowers have typically progressed through a four-stage cycle. The first stage involves a nation establishing dominance in global trade, which leads to increased wealth and manufacturing capacity. In the second stage, the nation becomes a leading provider of financial services, lending capital internationally. The third stage is marked by the nation's currency being widely adopted as a global reserve, held by central banks around the world. This status allows the country to borrow at lower costs and maintain trade deficits more easily. In the final stage, debt levels tend to increase, industrial activity may decline, and imports often exceed exports. Over time, other nations may gain influence, and the previous reserve currency can lose its dominant position. This process leads to the emergence of new financial leaders. Both Britain and the United States have experienced this progression. Currently, China is advancing through these stages, contributing to changes in the global financial landscape. Central banks, such as the U.S. Federal Reserve, play a significant role in the global economy. These institutions operate beyond national borders, shaping the flow of money and credit internationally. As managers of the world's reserve currency, central banks influence global markets. The US dollar in particular serves as a foundation for international trade and investment, providing the United States with a distinct position in the global system. The global demand for dollars allows the United States to finance deficits by issuing debt at relatively low costs. This enables the US to borrow more affordably than most other countries, supporting its economic activity. This arrangement supports government spending and can lead to increased debt and money creation, often referred to as quantitative easing. When government expenditures exceed revenues, the central bank can create new money to purchase government bonds. Over time, this process may reduce the value of the currency, which can be a concern for foreign creditors. Inflation and currency devaluation become considerations, especially for those holding substantial reserves of dollars. As the United States issues more debt, creditor nations such as China evaluate alternative options for storing their wealth. They assess whether the dollar will maintain its value over time. China, a major creditor, holds significant amounts of U.S. debt and is gradually diversifying its holdings. This includes investments in other currencies, gold, and various strategic assets worldwide. These actions are part of standard risk management. Nations seek to protect their interests in a changing financial environment. As the U.S. increases its money supply, there is a growing incentive for others to consider different options for stability. Both investors and governments look for secure and reliable assets. The gradual adjustment of reserves and investments reflects an ongoing transition in global finance. These developments may have long-term effects. Countries such as China are developing financial systems and networks to participate more actively in global capital markets. This process is gradual and ongoing. Each decision and investment contributes to the evolution of the financial landscape. The structure of global finance is evolving. Adjustments are being made as countries and institutions respond to new circumstances. The future of global finance is being shaped by these developments. The outcomes will influence the distribution of money and economic activity for years to come. The US-China trade war was intended to reduce American dependence on Chinese goods. Tariffs were implemented to discourage investment and encourage changes in supply chains. During this period, China expanded access to its financial markets for international investors. Initiatives such as Stock and Bond Connect enabled foreign investors to participate directly in Chinese markets. Restrictions on foreign ownership were eased, allowing greater participation from global financial institutions. As a result, while tariffs affected goods, capital inflows into China increased significantly. For many investors, the scale of China's market presented substantial opportunities. Despite trade tensions, financial connections between the two countries continued to grow. The landscape shifted when MSCI, a leading index provider, started including Chinese stocks in its global benchmarks. This adjustment required passive funds to allocate capital to Chinese assets, independent of political considerations. Each increase in China's index weighting resulted in additional investment flows. For financial institutions, the focus remained on tracking the index and meeting client needs. Excluding China from portfolios could lead to underperformance relative to benchmarks. The choices made by index providers now influence global capital flows more than many government actions. Including China reflected its significance in the global economy. The trade war was a temporary event. The integration of China into global finance represents a long-term development. The direction was clear: track the index, recognize growth, and observe capital movement. The movement of $1.4 trillion into China was the result of several intersecting factors. China's market reforms and inclusion in global indexes increased accessibility for international investors. At the same time, Western economies experienced low growth and persistently low interest rates. China presented comparatively higher yields and stronger growth prospects, attracting global investment. The trade war underscored the importance of diversification for many investors. Many portfolios were heavily weighted toward the US dollar, prompting a reassessment of currency exposure. China's economic cycle began to diverge from that of Western economies, providing a potential hedge. As a result, Wall Street firms increased their presence in China to pursue long-term opportunities. The capital movement reflected a logical adjustment to evolving global conditions. The global financial landscape was undergoing a significant transition. To understand the current changes, it is helpful to consider historical context. Britain previously held a leading position in global finance, but after 2 world wars, it became a debtor nation, and the US dollar became dominant. The United States' industrial capacity and creditor status contributed to this transition. After the war, Germany and Japan developed strong export economies and accumulated US dollars, but the dollar remained the global standard. In the present, China demonstrates similarities as a major manufacturer, a significant creditor, and an emerging financial innovator. China is gradually opening its markets and encouraging the international use of the yuan. The movement of $1.4 trillion from Wall Street indicates that investors recognize China's growing role. These investments reflect expectations about China's development from a manufacturing center to a financial hub. This progression is consistent with historical patterns of financial leadership. The change is occurring gradually and can be observed in global markets. Governments and investors are monitoring these developments and adjusting their positions. China's role in global finance is becoming increasingly prominent. The current shift in global financial power is occurring gradually, following patterns seen throughout history. Financial influence tends to move toward regions with the most growth and opportunity. The United States, which was once the world's leading creditor, is now its largest debtor. Its position relies on international confidence in the dollar and the stability of its financial institutions. At the same time, China has become the world's top trading nation and a significant creditor, expanding its financial markets and infrastructure to support its economic role. By opening its markets to foreign investment, China is creating conditions for the yuan to have a larger presence in international finance. The movement of $1.4 trillion in capital reflects a significant transfer of resources from debtor to creditor nations and from slower to faster-growing economies. These investment decisions are not driven by political motives, but by the pursuit of returns and opportunities for growth. The dollar remains the dominant global currency, but there is a gradual movement toward a more multipolar financial system. Countries are diversifying their reserves, and more international trade is being conducted in local currencies, which reduces reliance on any single standard. China's bond market is developing quickly, providing investors with an additional option alongside traditional Western assets. This process is not a sudden replacement of one financial power by another, but a gradual rebalancing and redistribution of influence. The global financial system is adapting to new circumstances and shifting centers of activity. The future is likely to feature several centers of capital and influence, rather than dominance by a single nation. The $1.4 trillion in capital movement marks an early stage in ongoing changes within the global financial landscape. The movement of $1.4 trillion into China during the trade war highlights a fundamental reality. Economic factors often outweigh political considerations. As political discussions continued, capital gradually influenced the structure of global finance. This represents a gradual, structural change that will influence the coming decades. The addition of Chinese assets to global indexes formalized this development. The global financial system is transitioning from a dollar-centric model to a more multipolar framework. The yuan is expected to play a larger role alongside the dollar, rather than replacing it immediately. Investors and policymakers will need to adjust to a landscape where both risks and opportunities are more broadly distributed. The trade war served as an indicator of these ongoing changes. The evolution of global finance is shaped by the steady movement of capital. Gaining insight into these trends is essential for understanding the future global economic environment.